Welcome, Anders. It's time for a short update. Over the past couple of weeks, we've had the central bank and inflation numbers spreading a little bit of holiday cheer over the markets. If we start with the Fed, they left rates unchanged. What do you say about their approach?
Well, I do think that the Fed is in a fairly comfortable position, and Chairman Powell was also fairly clear. He said that Fed needed now to start to consider when to begin to dial back the restrictive policy that is in place, and that's clearly an indication that we are not only seeing the end of rate hikes, we are also starting to see on the horizon some cuts coming. My best guess is that we will have to wait until second quarter, and whether it's April, May or June, I think is an open question, and will obviously be depending on what type of inflation numbers we're getting in January and February. Mm-hmm. But fundamentally, wage increases have come down, productivity has come up, so unit labor cost, the real important core of inflation, is below 2%. And given that wages are continuing to soften a bit, I think there is a good probability that Fed actually can start to cut rates, and therefore I think the US economy actually could be fairly resilient also in 2024. So we've actually seen 22, 23, and then maybe 24 coming in at around 2% growth, which is a fair number in these circumstances.
Mm-hmm. And the ECB, they also left rates unchanged, but slightly more hawkish comments. Opportunities, challenges for Europe, what does that indicate?
Well, we saw inflation in Europe surprising substantially on the downside with a print of 2.4. So they had this good inflation number going into the forecast and monetary policy meeting. But Fed are in a better position than ECB. Clearly, wage increases in Europe are much higher. Clearly, productivity is softer. So the underlying cost pressure in Europe is more problematic. But one have to note that growth is also substantially weaker in Europe than in the US, and particularly in the northern region where Germany is seeing very, very lackluster growth. So I do think eventually coming into 24 that also ECB will start to cut rates, because you need to support growth. Inflation is clearly on a downward trajectory. It might bounce back from this 2.4 number a bit, but fundamentally inflation is on its way down, and with very, very soft activity. The right thing for ECB to do is to cut rates during 24, and probably we should add that there is actually almost no central bank that is not planning to cut rates in 2024. We're going to see a lot of banks ranging from Bank of England to almost all the other central banks.
And inflation numbers clearly coming down faster than anticipated. What does that mean going into 2024?
Well, I mean, first of all, we should note how big the change is. UBS does a GDP-weighted global inflation number, which includes over 100 countries. And if you analyze the last 3 months numbers, we are actually at 1.8% in annualized inflation rate already in November. So there's been a very, very large move. And the last few weeks have been actually fairly good in that respect. It started out with a 2.4 in Europe. Then we had a kind of as expected in the US. But then again, the same day, Norway and Denmark came in lower than expected. Sweden has come in lower than expected. And this week we saw UK coming in substantially lower than expected. So clearly inflation over the last 2 or 3 weeks have been a very supportive for this trend towards lower interest rates. And if you go back just 4 to 8 weeks, we had a huge worry about US 10-year bond yields ranging up and peaking at over 5%. And now we are well below 4. And I think that is really constructive for the markets.
Some extremely low rates in China also. Any words on that?
Well, China is clearly the outlier when it comes to inflation. The year-on-year number is minus 0.5. So the very slow progress when it comes to dealing with the real estate sector has pushed deflation in China. China is losing a lot of competitiveness due to this trade war. So clearly we also see that they are exporting deflation. Chinese export prices are falling double digit. The rational thing for China would be to cut rates more aggressively and allow the RMB to depreciate substantially. Xi Jinping, the president, has clearly signaled that they want to keep the RMB stable, and therefore there is a lot of deflationary pressure in China. So growth is going to be slightly softer next year, but soft growth in China means more than 4% growth. So let's remember that. But I do think that there is a potential for PBOC to do further rate cuts in 24.
Shifting to Sweden a little bit, if you were the Swedish Riksbank, what would this mean for you, all of this? Where are you now? What do you do now?
Well, I think the Riksbank will also cut rates during the spring. We heard Erik Thedéen yesterday being slightly hawkish, arguing that inflation eventually could come up again. But I think we should note that the global trend is clearly downwards, and the Riksbank also has a high credibility, given that wage increases here are much lower than in Germany or the rest of Europe. So the Nordic area is seeing much more responsible unions and labour market partners. So I do think that the Riksbank wants to sound hawkish because they are worried about the krona, but eventually I think they will start cutting rates also in Q2, and I do believe that the krona has quite a lot of support now from the fundamentals.
Also, I guess turning to the Middle East, maybe the only positive is that oil prices have remained somewhat stable. What do you read into all of that?
Well, the region seem to have convinced themselves that it's a low risk of this spreading into a broader conflict. So for November, for example, Israel stock market and Saudi stock market were among the best performing in the emerging market segment. So clearly that has rebounded. There are worrying signs of terrorists hitting oil tankers in the Arabian Sea. I feel fairly confident that US Navy, in cooperation with other navies, will be able to sort this out, but clearly it's pushing tanker rates up a bit. But it's comforting that oil is hovering around 80. I think a US dollar price of 80 per barrel is kind of a central tendency also for next year. So it can go from 70 to 90, I think, but as long as we keep it in that range, it's not the major inflation worry.
Okay, and we'll soon have 2024 upon us. So any emerging trends or potential challenges you see for investors going into the new year?
Well, I do think that the US stock market has a solid foundation in fundamentals. If we can see the 10-year discount rate come down to 3.5, and if the companies are delivering on the expected 11% increases on earnings per share, I do think we could see kind of a normal increase, roughly 5 to 8% from these levels during 24. For Europe, we are lagging a bit. The large German manufacturing and automotive industry is under pressure. The chemical industry is under pressure from the energy issue. But I think, for example, the Nordic industrial companies are in a very strong position with good access to energy, support from a fairly low valued krona. So I do think that there are pockets of good companies in Europe. And if you look at valuations, they are clearly below the US. And if we look at the emerging markets, this is one of the points in time where valuations are really low. So you could find interesting companies in India, Indonesia, Vietnam, etc., where the PE is below 10 and earnings per shares are well above 10. So I think it's an interesting segment to look at. I think we've, over the last years or so, only had this low valuation for 10% of the time. So that there is maybe an opportunity also in the emerging market space.
Mm-hmm. Sounds like it will be an exciting year and also some good opportunities.
The only thing we can be very certain about is that it's going to be exciting, and that there will be a bumpy ride on this roller coaster that we have as a stock market.
With that, I wish you a Merry Christmas and a very Happy New Year.
And Merry Christmas and Happy New Year to you and all of our listeners.